For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money with Randy Floyd, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, then what to watch for before you do your IRA to Roth conversion, also alternative investments in your retirement portfolio, life changes, so should your estate plan. My name's Jeff Shade. As always, I am just here to ask the questions, but the words of wisdom and solid advice, they come from Randy Floyd, Floyd Financial Group. Randy, good morning. How are you doing today?
Doing very well, Jeff. I'm just excited to be here today.
Well, me too, Randy. It's like old times. Remember back in the old days when it was just you and me before Jake grew up and became a big guy here in the firm. Jake is off this week on a little well-deserved vacation with his family, so it's just going to be Randy and me on today's show. Well, Randy, we got a lot of great things to talk about. It feels like the markets have been riding a roller coaster lately, from inflation data to Washington drama. When you look at the next few weeks, what are the key things that you're watching most closely?
Yeah, sure. So we got a whole list of things that we're going to talk about. And actually, we're going to call this segment today, rather than current events, we're going to call it headlines, because that's what we're talking about. These are the things that we must address and need to be addressed, and also are the things that, as you've kind of alluded to, affect what happens with the market, what happens with how people feel in general. Because, you know, the headlines that people read do what?
I give up. What is the answer?
Well, the answer is headlines affect everything about us and how we perceive the world, and actually even things that are imperceptible. And what I mean by that is, years ago, my wife was having some hormonal issues, and she went to the endocrinologist, and they were going to do a little study on her. And before they would assess her situation, they said, now remember, when you get up in the morning, you can't watch any TV, you can't watch any soap operas, you can't watch any movies, no headlines. And she said, why? She said, because all those things affect your hormones. So we don't realize sometimes what headlines are doing to us. Now, let me tell you, the journalists that produce them, they know exactly what they're doing to us, because they're trying to get our attention. But we got a lot of good things to talk about today.
So let's start off with the market in the headlines. What's going on in the market right now? What are we looking forward to here in the next few weeks, the next few months?
Yeah, so Jeff, I am still optimistic about what's going on in the markets. Now, the world is a mess, as we know. However, it's maybe somewhat less messy than it was just a few weeks ago. There's all of the rumors of wars and wars. Some are getting solved, some are not at this point. Everything from the tariffs, the government shutdown, and what that means for everybody. Of course, the No Kings rally. I'm not quite sure what that was about, since we don't really have any kings in this country.
Yeah,
but
exactly.
Anyway, so just a lot of things have been pulling on people's minds and psyche, if you will. So let's kind of go down a list, I think, is probably the best thing for us to do. And I'm going to kind of order these where I think it maybe makes the most sense based on what we just talked about here. So let's talk about what's going on. Next week, and I guess it is, we have the mayoral race in New York City that is going to happen. And, you know, we have a pretty far left-leaning individual up there that they say may actually have an opportunity to win this election. Now, what we have is we have a divided ticket up there. I was watching an interview this morning with a gentleman that I've followed for years, being in the investment business. His name is Bill Ackman, and he runs a company today called Pershing Square, an investment company, a hedge fund, basically.
Right.
But way back, he was involved with Herbalife, was trying to really build and grow, and he was betting against those people all the way through. That's where he kind of cut his chops way back in the day. But basically, one of the things that he was saying is that Trump is the most pro-business president that we've had. But he said that this Mr. Mamdani is exactly the opposite of that. And in fact, one of the things that he wants to do is he wants to raise the state income tax on corporations. Are you sitting down?
I'm sitting down. I'm actually holding on to my chair, so go ahead.
To 21%.
Whoa.
Now, that's the state income tax. We got to remember they still have the federal that they have to deal with. And basically, he doesn't think that anybody can do anything about that, and that won't affect anything that happens in New York City. Well, he said in today's world, with the Zoom meeting and not having to be face-to-face like we've had to be in years past, where New York, everybody came to New York so they could meet and sit across the table from each other, he said companies are more movable than they've ever been. And he said these companies will move out of New York.
Oh, yeah, absolutely. I think they're already
money.
moving out of New York now because of taxes, but even more so if he becomes mayor.
Exactly. And so he was encouraging everybody to get out and vote. This is a guy that wants New York City to own the grocery stores and things of that nature. It's just crazy what he's looking for. So anyway, we're hopeful and praying that this gentleman will not be elected. The thing that I did hear Mr. Ackman say, though, and he kind of mirrors some other people that I've been talking to and my own take myself, and that is that we are actually starting in an uptick in the economy, not the other way around, where some people say, oh, we're headed for a recession. We've kind of been in a rolling recession, not a big one, but just kind of a rolling recession for a little while now. But I think we're about to come out of that with interest rates coming down, which we're going to talk about here in a minute. That's going to help disperse some growth. Not to mention the fact that all the investment coming back to America is really good for us.
Well, we'll wait and see what happens in the Big Apple. I lived there and I lived in Seattle, and it would be a shame for New York to go Seattle's way. But again, there's nothing that we can really do about that. We can only hope that he does not get in. Talk with Randy Floyd, Floyd Financial Group. Again, our show called Show Me the Money. Our phone number, 417-889-7233. If you'd like to come in and sit down and talk to Randy or Jake face-to-face about your journey towards a confident retirement, no cost, no obligation, 417-889-7233. Let's talk about interest rates. October 29th is the big date. What is your prognostication, Randy, about what's going to happen there?
Yeah, Jeff, I think it's pretty well baked in the cake that it's going to be at least 25 basis points. However, I would not be surprised to maybe get shocked with a 50 basis point cut. Now, I would welcome that for sure. I was looking at the Fed funds rate and kind of where it's been historically. Now, for a lot of people that are saying, what in the world is the Fed funds rate? The Fed funds rate, that is what banks get to charge each other, what the federal government charges banks to borrow money. And so basically banks get to borrow 10 times their net asset value from the Fed at these rates. And so what we're looking at here, let's just look back historically. You know, in 1954, Jeff, banks could borrow for 0.75%, which meant that probably back in the 50s, 3.5% and 4% interest rates on houses and things were pretty common. By 1958, it had gone up to 3.25, back down to 0.75. In 1960, it was 4%. Now I'm going to fast forward 1981. Do you want to have a guess as to what the Fed funds rate was in 1981?
Well, considering the fact that mortgage rates were really, really high back then, I'm going to guess double digits. I'm not sure.
Very much so. 19.1 was the average. Well, that's why there was some 21% prime is what it was back there in 1981.
Yeah.
Now, after they got inflation under control, Mr. Volcker was our Federal Reserve chairman. Then he raised interest rates one day 8%.
Oh my gosh.
Yeah. So we look back after he got it under control, it went down by 82 to 14.45, and then 83 was 8.6. By 1993, we were at a 3% Fed funds rate. And then, of course, we had what? In 1999, 2000, 2001, we had the dot-com bubble.
And it burst and splattered all over the walls.
That's right. And interest rates went to 0.
Oh, my gosh.
So they could spur growth, right?
Yeah.
And then by 2004, it was 1. Then by 2007, it was 5.25 because there was no limit to what people would borrow in those days. And so they were making their money. And then we had the crash 7, 8, and 9. And by May of 2009, we were back to 0 Fed funds rate. I'm going to wrap this up, but it's important that people know that this has always happened. This is nothing new. It's just we have to work through these situations. Now, by December of 2015, so from 9 to December of 15, so 5.5 years, it went to 0.25. And then in 2019, it was 2.4. And then guess what happened in 2020 when we had COVID? Back to 0.
Yeah.
That's why we had 3% interest rates on homes.
Right.
And then in March of 2022, two things happened. The market, it went down during COVID, then it bounced back after we printed $6.5 trillion of new money and put it in the system. Then, all of a sudden, inflation's out of control, so it goes from 0.25 to 5.33, which is why we had 7% mortgage rates. Also broke a few banks along the way. And currently, right now, we're at 4 to 4.25. So that's why interest rates across the country, right now, 6.35 is the high. 6.22 is about the average across the country on a 30-year mortgage. There's a few people at 5.99, but with this next tick down, we could probably get well into the fives. And if he goes down 50 basis points, we might get down to 5.5. And I'm going to throw out one last thing. I know I'm throwing all kinds of numbers here, and people hate this when I throw out numbers, but here's the good news.
Yeah.
By January of 26, we think the interest rate may be down to 3.25, which would mean we'd have 5.25% interest rates.
Wow.
And looking forward to that, they think it's going to bottom out at about 3, which would put us at 5% rates rather than where we're hanging out now. So you have to figure out, on an average home across the country right now, 1% is $4,000 a year in interest to people, which is about $320 a month savings. So that is significant. And I know that was a whole bunch of stuff. But hey, interest rates are going to come down, and that's going to be good for small business able to borrow at lower cost, but also it's going to spur people to buy more houses. So it's going to turn things around.
Well, I was going to ask you, do you think that interest rates will ever go back to 3 and 4%? I think you just answered that question. It looks like that there's a possibility that they will.
Yeah, everybody is trying to figure out right now what they call the neutral rate.
Right.
Neutral meaning it's not hurtful by being too high, and it's not overly aggressive by being too low, causing people to maybe overborrow and accelerate problems that way.
All right. Well, let's continue now with our headlines here. Let's talk about earnings season. What is it? When is it coming up? And what do you expect that we're going to find out?
Yeah, so earnings season, we're seeing that things are really coming together and looking pretty good. One of the headlines I saw, in fact, just a couple days ago, I was scrolling on my phone in the morning, as I sometimes do on CNBC, and it said, General Motors lost $1.6 billion because of EV sales fall off due to no more subsidy, right?
Yeah.
But they didn't tell us the rest of the story. And the rest of the story is they had estimated they would earn $2.30 per share during the third quarter of this year, but they actually earned $2.80 per share, which is 50 cents a share. Or if you think about that, that is approaching, 20% more than they thought they were going to earn. So it's funny how, the headline was really negative, right?
Right.
But when you get underneath it, they're doing fine. In fact, it even said, are you ready for this? And this is going to blow people's minds. Business was up in China for GM.
That's
so
crazy.
I said, you really got to watch who you listen to, right?
Everybody's got some sort of slant on things.
And the general guidance looking forward from General Motors is positive and up. Now, when we look at earnings season, a lot of people have been saying here recently, well, all that's propping up earnings right now are these magnificent 7 companies. That's Tesla, Meta, which is the old Facebook, Amazon, Apple, Microsoft, NVIDIA, and Google. Those are the ones. And those guys are up 14.9% year over year. And they also represent 27% of the market. Those 7 companies are 27% of the total stock market. Now, the other 493 companies out of the S&P 500, or roughly that number, represent 73%. And the people will say, but all those companies are doing horrible. While there's always companies that are not doing well, those companies have had positive growth of almost 7% year over year. So again, as bad as people like to make it out to be, it's really not that bad. And there's still plenty of money in the system that is going to find its way to real estate prices and the stock market.
Again, talking with Randy Floyd, Floyd Financial Group. 417-889-7233 is our number. If you'd like to get in and sit down with Randy or Jake here on a one-on-one basis, have a casual conversation at no cost and no obligation. 417-889-7233. Randy, 'tis the season for RMDs. For those people who do not know what RMDs are, what are they and why is it so important?
Sure. The RMD is the required minimum distribution that you must take from a qualified retirement plan, such as an IRA or a 401k, an old 403b, maybe a simple IRA. Once you hit a certain age, the government says, hey, you've been tax deferring this stuff for a very long time. We now want some of our money. So what is this thing called the RMD? So if you were born between 1951 and 1959, this year, you're taking your required minimum distribution because you will be at least 73 years of age, and you must take your first RMD before April 1st of the following year after you turn that age. If you don't, you'll have to take 2 in the same year, which might push you into the next tax bracket. Also, if you don't take that, and I'm going to tell you how to calculate it here and how much it'll be roughly in a minute, If you don't take it, the government used to charge us a 50% penalty, but the Secure Act 2 lowered that to 25%. Now, I still don't know anybody that wants to pay a 25% penalty.
I know.
Oh, by the way, and you're paying income tax.
That's right.
So if you're at 12% for the Fed and 5% for the state, that's 17 plus 25 is 42. Nobody wants to do that. So that's the reason we're taking just a moment to make sure if you haven't taken your RMD, you've got a little bit of time to do it yet. It's never too early to start because sometimes this time of the year, people wait till the last minute to do things and then companies get backed up and it can be very hard to get done sometimes. So basically what it amounts to, the first year that you're going to take your RMD, it's about 4% of whatever your balance was the end of the previous year. And every year around the middle of January to the middle of February, you get this thing called the fair market value letter in your mail that says, hey, this is the fair market value of your IRA. And then you go out and look at your age and there's a divisor you divide in there. And the first year it's about 4%. So that's what you need to get taken.
Let's wrap up this segment on headlines by talking about the currency market. What's going on there, Randy?
So of late, we've been hearing people say, oh, the dollar's imploding and it's bad, it's no good, da-da-da-da-da. Well, if you look back historically here, the dollar was at all-time highs here in the last 2 or 3 years. And even before that, we had a really, really strong dollar. Now, currency markets are always shifting and changing based on what kind of debt people have, what are their bond yields looking like, what's the confidence of people, how's their economy going versus their debt. There's all sorts of things that affect that. But here's what I would tell people. Right now, the dollar index is showing more strength, again, against other currencies. But us to have a little bit weaker currency sometimes is good because when we are trading internationally, if our currency is really strong, when we look at the exchange rate, if somebody wants to buy a car from here, and let's say it would have been $50,000 here in our market, but our currency is 10% stronger than the currency they're going to, you got to add $5,000 to that price for the person that's going to buy it in the other country, right? We're always trying to figure out what is this delicate balance that we really need between trade deficits that we're trying to work out and trade surplus. Generally, countries that have a lot of trade surplus, it's good for their currency. If you have a lot of trade deficits, it's not so good. Now, our dollar is the only currency out there really that has bucked that trend forever. And that is, yes, we've had a strong dollar, even though we've had trade deficits with the world. But Trump is figuring that out, and that's going to happen. I'm just excited about what the future holds as we repatriate some business back to this country.
Well, that is a lot that we have learned this morning here, Randy. I appreciate you being on all of these things for us. And now you know the rest of the story, as Paul Harvey used to say. And I'm not going to do a commercial for Neutrogena that could even soothe the hands of a Norwegian fisherman. But anyway, we remember Paul Harvey very, 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 very fondly. Always enjoyed him. Listening to Randy Floyd here, Floyd Financial Group. My name's Jeff Shade. Glad you could join us here on this Saturday morning. Once again, our phone number, 417-889-7233. If you have questions about the market, the economy, you're not sure whether or not your portfolio is positioned for times like these, come on in, sit down and talk with Randy at Jake here, Floyd Financial Group, and see if we can poke some holes in your portfolio. If you don't have one, we'll certainly get one started for you if you want to begin that conversation. Again, it's 417-889-7233. And remember, no cost, no obligation, no judgment will meet you where you are. 417-889-7233. We're also online at floydfinancialgroup.com. Randy, let's continue our conversation this morning. I know that the clock is ticking down. The calendar is moving towards January. What else do we want to be concerned with this year?
Sure. One of the big things this time of the year, or, well, almost any time of the year, I get this question a lot, is should we do a Roth conversion on our IRA? And that's one of the things we'll kind of wrap up with here because, you know, when we're funding IRAs, whether it be Roth or traditionals, we have until 15 April of the following year generally to do so, right? But if you're going to be converting a traditional IRA to a Roth, and people say, well, why would I do that? What's the reason? People say, well, because the Roth distributions are tax-free, and so we're going to qualify that just a wee bit. So if you're going to do a Roth conversion, you have to do it within the calendar year. So we have a 12/31 deadline, number one, would be the first thing to consider. If you haven't thought about it, it may be too late this year for you to really consider. But what you should do, whoever your tax planner is, or if you don't have one, talk to us about it. What we would do is look at your current situation, your specific situation, and see if it makes sense to do a Roth conversion or not. I would tell you this. Many times when we look at what the tax cost is versus the potential tax savings, it ends up that we really don't need to do the Roth. Now, why would that be? People say, well, tax-free is tax-free, except for the fact that when you convert, you have to pay the current tax. So if you're working still, looking to do a Roth conversion, you've got your income on top of whatever the Roth conversion is. That may push you into a 22, 24, or a 28 or a 30% tax bracket. And all of a sudden, you've got 30% less money to work with in your Roth than you had in your traditional. And if you consider what your tax bracket may be looking forward, it may not fit and be the best outcome for you. Not to mention the fact you've got to wait 5 years before you can tap those interest or earnings-free incomes.
Randy, how important is timing when it comes to doing a Roth conversion? Should people be thinking about it at the end of the year, or does it really depend on their income situation?
The first thing I would say is, yes, timing is important because, again, if we're going to do the conversion, we have to do that within the calendar year versus if we're funding a Roth along the way, just making our annual fund, we can do that on tax day each year. So we have till April to get that done. Also, the thing that I would say, too, is if markets are down, sometimes it's a good time to actually do that because you might save some tax money and catch a strong rebound. So that's something that we can think about. However, I would tell people and caution people, don't wait for a downturn to convert to your Roth, right? Don't do that on purpose. But I'm just saying sometimes that can affect our long-term strategy. But I think the biggest thing is if they haven't planned on doing it this year, it may be too late to get done. But if you are thinking of doing it, let us run a what if for you and show you the different scenarios and what it might cost and what the ultimate outcome will be for your income stream and the future taxation versus the current taxation you would have to realize.
Randy, does the current market environment like lower stock prices or volatility affect whether now is a good time to do a conversion?
Yeah, again, that's one of the things we look at is what's my valuation now? And one of the big things we always talk about here is, yes, we have volatility in the stock market. So let's talk about something that's kind of off topic here, risk versus volatility. Jeff, when would you say Microsoft is going out of business?
Gee, I'm going to say almost never.
Probably not in our lifetime. So yes, we may have stock price volatility at Microsoft. We're going to have, based on what's going on with interest rates and who blows up who, and maybe Oracle comes out with a new product that competes with Microsoft and it causes their stock to go down for a little bit, whatever it may be. But that company's not going out of business and it will be back. The main thing is how many shares of that stock do we own and do we keep them through the volatility? Risk is a thing like Rivian, where Rivian was a car company that came out during COVID that came out at a valuation of $100 billion and they'd never delivered a car. And today they're worth 12 cents on the dollar.
Right.
That's risk versus volatility. So yes, sometimes when markets are off, it is a good time to do the Roth conversion. Not to say that it's not a good time when markets are up as well, but it certainly is something we always consider.
Yeah, I've seen those Rivians coming down the road. I don't see them very frequently, but they do have unique headlights. And I always figure you could probably buy those things for about a 12th of what they originally cost.
And they are pricey, like over $100,000 for one of those little pickups.
I know, isn't that crazy? Let's talk about when you should do a Roth conversion. Should you do it all at once, or can it be done in stages?
Yes, it can definitely be done in stages, and I would recommend that because think of it this way. If you're getting ready to retire and you think, hey, this Roth conversion sounds like a good idea, let's say you're making between you and your wife $100,000 a year at your job. You're going to fall in the 12% tax bracket for the Fed and probably 4% for the state of Missouri. So you're 16% in taxes. Now, if you add an extra $100,000 to that to convert the Roth, you're going to put yourself up into the beginning of the 22% tax bracket, right? And then you're going to be at the full 4.9 for the state of Missouri. Versus if you're going to do $500,000, you're going to put yourself up into a 35, maybe to 40% tax bracket. So it's one of those things that we really need to walk it in over time. And the earlier you start in this process, if you really think you want to do it, the better. If we can do it over a 5 or a 10-year period, it can really make great sense to do them. But boy, if we're close, doing the whole thing may not even be an option. And it may be that we just want to do a portion of what you have to help reduce your tax burden in the future.
Randy, what are some of the hidden costs that people don't always think about?
Oh, yeah. We've got this thing called IRMA. So if you're 65 and you're on Medicare and you breach around $200,000 taxable income as a married couple, you get to pay extra for Medicare. How
Lucky
about that?
ya.
Yeah, lucky us. So Irma, she's no good.
Never
Yeah,
liked her at all. Yeah.
that's right. The other thing is she comes right along with that lady's Social Security taxation, and that is depending on how much money you make as an individual or as a couple determines how much of your income is taxable at the federal level. Now, of course, Missouri has been kind to us, and they have stopped Social Security on taxation for us as of last year.
Well, if someone is nearing retirement, Randy, are there situations where it just doesn't make sense to convert?
Absolutely. If you're sitting here and you fit firmly within the 12% tax bracket, especially after Trump and his big, beautiful bill got his tax cuts locked in now, right? If you're going to stay in the 12% tax bracket now and you're going to be there in the future, or maybe now you're in a higher tax bracket and you're going to be in the 12% tax bracket looking forward. By the way, for a married couple, the 12% tax bracket right now is a gross income of around $125,000 a year. So if you're going to be at that level and less, it may not make any sense to do the Roth conversion at all and prepay the taxes. Now, one reason some people do Roth conversions is they want to prepay taxes for their beneficiaries. So that is one additional thing that does come into play sometimes.
Talking with Randy Floyd, Floyd Financial Group. We're talking about what to watch for before you do your IRA to Roth conversion. Again, if you have questions about this, give us a call here at Floyd Financial Group. You can do it right now if you want. 417-889-7233. Leave your name and telephone number. Lovely Ashley will pick that up on Monday. She'll give you a call back and set up a convenient time for you to come in and sit down and talk with Randy or Jake here at Floyd Financial Group. We can talk about IRAs to Roth conversions, pretty much anything you want to talk about. Again, there's no cost, no obligation, certainly no judgment whatsoever. We'll meet you where you are. Again, it's 417-889-7233. And once again, you can find out more about us online at floydfinancialgroup.com. Randy, let's take a break. When we come back here on Show Me the Money, we're going to be talking about a topic that's generating a lot of buzz in the investment world today, and that is alternative investments. When our program continues right here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shea.
Welcome back, everybody. This is Randy Floyd. You're listening to Show Me the Money. And in this segment, we're going to be talking about alternative investments, what they are and why we don't use them.
Okay. Well, we're going to find out more about that, Randy, why we're not using alternative investments. But I think it's a wise idea to learn about alternative investments. It's a topic that's generating a lot of buzz in the investment world about alternative investments and what they might mean for your retirement plan. So let's start with the basics, Randy. When people hear alternative investments, what exactly are we talking about?
Yeah, so when we look at alternative investments, I mean, what's really happened over the last 100 plus years, it's pretty much become that retirees and even most people are involved in the mainstream market. And when I say the mainstream market, I'm talking about the stock market, the bond market, the interest rate market, those things, for a couple of reasons. Number one, what are private equity or what are these alternative investments? I call them private equity. That's what they are. Private credit, venture capital, real estate investment trusts, REITs for short. And some people will say, oh, I know what that is. I didn't know what a real estate investment trust was, but I know what a REIT is, right? R-E-I-T. Even commodities, things like pork bellies and grain futures and all that sort of thing. Many times those can offer us some higher returns, but they also come with more risk. And then also they're illiquid. With a lot of real estate investment trusts, just to give you an example, they'll come out and they'll say, okay, hey, we're raising $500 million so that we can build nursing homes. And you'll get a 5% distribution or a 6% distribution on your money. And it all sounds really well and good. And I will tell you, back in the 70s and 80s and 90s, there were some great real estate investment trusts out there. A lot of those even went public, but most of these ones that start private, and if you can't stick out the 10 years or so, you're going to get caught holding the bag and get half your money back. You're going to get paid along the way, but generally they're paying you with your own money is what ends up happening. And the reason is there's so many fees built in for the managers and the takedown costs early on in those things. So I would just tell you, they're not a favorite deal of ours. Commodities, again, can be very volatile. Can you make money there? Absolutely. I won't tell you that you can't make money in any of these investments, but I will just tell you that for most retirees, what they're concerned about is return of my principal if I need to get it in a timely fashion, not trying to find somebody that can buy me out, which is what ends up happening in many cases, or you have to go to the secondary market and you get less than you paid. And most retirees are not at the situation where they're worth 50 million, 100 million, even 20 or 25 million, especially in our market. A $10 million investor is a big investor, and they don't have the time or the wherewithal to tie up a big bunch of money and wait for the next business cycle, which may be 5 to 7 years before they could even find a buyer to get out of some of those. I don't want to be too negative, but as you can tell, this is probably not one of my favorite topics here. And again, the reason is, and I've seen a lot of this over the years, and nothing against CPAs, but CPAs tend to lead people down these venture capital,
Right.
private credit, and private equity tracks. And boy, they sound good on paper, but I've seen too many bloody messes.
Yeah, well, CPAs speak a whole different language. I have learned that. So let's continue to talk about these alternative investments, Randy. We know right off the bat that you don't prefer them for a lot of folks. Who would alternative investments maybe be right for then if they're not right for most of your particular clients?
So there's some people out there that have what I would call generational wealth or have a lot of wealth. And sometimes they're even looking for a tax loss write-off that you get with some of these investments on the front end the first 2 or 3, 4 years. And then knowing that eventually down the road, the investment will pay off and maybe they'll even just get their money back and they save the tax burden. And that's fine, but that doesn't fit for a lot of these people. Also, we have people that are maybe younger and they have a longer time horizon and they can wait till they can hit the home run, or they can wait for the business to develop and grow in the private equity sector. One of the things I will tell you, I don't know if you remember back during COVID when BlackRock and a lot of these companies, I mean, those private equity sectors grew and grew and grew, and there was lots of credit issued out there. And now it's coming home to roost.
Yeah.
People are suing them because they can't get their money back and all sorts of things. So we prefer for retirees, we want something that we can look at that's somewhat predictable, that we understand the liquidity features of it so we can get to money if and when we need to.
So alternative investments may be not right for most of our audience, but they could be right for some people. As you said, liquidity is a big issue. And again, alternative investments are anything other than stocks and bonds and CDs and that sort of thing. But gold and silver, they're alternative investments. And still, I can't tell you, Randy, how many people I run into who say, boy, I'm going to get myself some of that gold because I saw William Devane on TV talking about it. And they're making, a good argument here about hedging against inflation, but gold is an alternative investment. What are the pros and cons of owning that if you're saving for retirement?
Yeah. So right now, gold is at all-time highs. I don't know. I haven't looked at it recently. Probably $4,300 an ounce.
Yeah.
The problem with gold is when you buy it, you pay somebody. When you sell it, you pay somebody. You got to know exactly when to buy and sell. It doesn't produce anything. As Warren Buffett said, all it does is sit there. And yes, it can grow in value. And yes, it's a stay of value. And one of the reasons that people own gold is they feel like that it's secure. And I got to tell you, if the big apocalypse happened that everybody is predicting will happen, Jeff, if you have gold and I've got fruit, vegetable, meat, coffee, and cigarettes, and the guy down the road's got some stuff that I want that I can eat and keep me going, you're starving.
Yeah.
So if you're buying it because of that reason, I don't think that's a good reason. Are there other investments that have done just as well? A lot of people say a lot of people made a lot of money in crypto, and crypto ran way up there recently. I'd almost call it a commodity, right? So it went up to 128,000. Then it was back down to 104, 105,000. So we've had a 20 or 25% movement in that thing in the last 2 or 3 weeks. So that volatility is pretty crazy. And gold will not be any different. The only reason that people are running there right now is there are a lot of people that are, like you said, listening to William Devane. He should have been a Kennedy. He just looks like a Kennedy.
He did play a Kennedy in a movie. He actually did. Bill did, yeah.
So, is it wrong to have gold and silver? Absolutely not. Is it something that I want to use to create and generate income for my retirees that depend on a monthly income? Absolutely not.
Talk about alternative investments with Randy Floyd, Floyd Financial Group. Again, our number 417-889-7233. Getting towards the end of the year here. If you do not have a financial plan or a plan to get you to and through retirement, we invite you to give us a call here at that number. Sit down with Randy and Jake. We can talk about pretty much anything you want to talk about. No cost, no obligation. 417-889-7233. You can also check us out online at floydfinancialgroup.com. Randy, when I think of alternative investments, to me, investment doesn't go with the word alternative because, correct me if I'm wrong or give me your opinion on this, that things like gold and silver and pork bellies and that sort of thing, they're really not investments as much as they are speculation.
In many cases, that's true. And right now, I mean, do I want to go buy gold at $4,300 an ounce? I don't think so. You know, people say, well, you're buying stock at all-time high prices. Yeah, but those stocks, as we talked about earlier, are producing earnings. Gold isn't producing any earning. In fact, I'll ask you, maybe you know this and maybe you don't. But if you were to look at the average return of gold from 1980 to 2023, what do you think the average annual return would have been?
Well, I don't know what the average annual return would have been, but I do suspect that there are other investments that would have beat it handily.
4.4%.
Oh my gosh. Okay. So I was right.
So, you know, if you look at it from 2000 to 2010, it averaged 10.9. But if you just look at it from 1980 to 2000, gold returns were very weak. Then we had a significant price drop in the 90s. And from 1994 to 2024, stocks significantly outperformed gold. The only reason I say this is, and again, there's nothing wrong if people want to buy gold, that's fine. Silver, that's fine. Platinum, whatever it is you want to buy, that's great. I'm just saying that for me, as a guy that is charged with helping somebody retire, stay that way, provide income and security, it can be a portion of it, but it's not my mainstay.
Yeah, and again, we're getting back to the liquidity issue. Randy, if I've got a gold bar here in my safe or something like that, I can't just shave off a piece of it and pay for some gasoline. It doesn't work that way. You know, it's fun to have, it's fun to hold and show people, hey, look at this gold bar here, but not very liquid. But you can own gold and silver and other precious metals in another form called exchange-traded funds. Does it make sense to do it there?
Maybe. The exchange-traded funds that we like to use, we like to buy gold miners stock and that sort of thing because it really kind of tracks gold and the price of gold because these are the people actually pulling it out of the ground. And what's nice about it is it's liquid, it's easy to get to, and we can just buy and sell as we need to draw income. And it doesn't cost anything to buy and sell, by the way, Jeff. That's the other thing.
Yeah, well, I wanted to touch on something I haven't asked you here. I've always wondered, we talk about commodities like pork bellies. What is a pork belly and why would I want to own that? Is it the belly of a pig? I mean, why do I want that?
Well, again, we've been talking a lot about cattle here, and even in the news recently has been where President Trump's trying to help us get beef prices lowered in the country by buying some Argentine beef. And a lot of people say, well, wait a minute, I thought we were trying to keep everything American made and all that. And we are, except that sometimes you have to have a little help from somewhere. Like they're talking about, I think the number was 12.2 metric tons of beef we eat per year, and we might buy as much as 2 metric tons someplace else. So we're going to keep the vast majority of production here. But right now, what we're looking to do is stay off inflation because here in this country, our cattle crop is just a little bit light right now, which is driving the cost. Now, also, to add to that, and this is kind of off topic, but we're looking at the old dietary pyramid that we've been living on for the longest time is about to be upside downed. So my dad used to say, Randy, eating fat won't hurt you and it won't make you fat.
As long as you don't eat too much of it, I guess.
Yeah. Well, some of the best cultures around are eating 50% fat. So
yeah,
we'll see how that shakes out. I'm not saying that I'm going to go out and start eating, I've got a pound of butter and a pound of vegetables here.
Yeah. Well, you were in the food business. I mean, when I think of pork bellies, I think low on the hog. We want to live high on the hog, right?
Bacon is pretty good stuff. And if you're influenced by the South, hog jowl is a good thing.
Hog jowls? Yeah. Pig's feet would be low, but that's where the saying high on the hog comes from, right?
Yeah. If you're eating high on the hog, you're eating pork tenderloin and ham and picnic shoulder, all that good stuff.
All the good stuff there. Talking with Randy Floyd at Floyd Financial Group. Again, we've been talking about alternative investments, and I think that we have determined, Randy, that for the most part, alternative investments do have a place, but not necessarily in someone's portfolio who is getting to and through retirement, just trying to make ends meet or saving enough for retirement. Like I said, there's a place for it, but maybe it's for people who already are maybe wealthy and want to stay wealthy. Anyway, 417-889-7233 is our telephone number. Again, you can find out more about us online at floydfinancialgroup.com. All right, Randy, let's shift gears here a little bit. We're talking about something now that everyone needs, but few people want to think about, and that is an estate plan. Randy, once in a while you have said that life rarely stays the same, and neither should your estate plan. Why is that?
Right. Everything is always changing, Jeff. If you think about when you were first married and maybe you had your kids, at one point I had my next door neighbor was taking my kids.
Really? Was it because they wanted to live there, or you just were tired of them? What was going on?
Well, my folks lived a long ways away, and
gotcha.
they were getting older and things like that. And then we had a really great relationship with the people next door. And we said, hey, if something happened, would you raise Jake or Miranda? And they said, well, sure. And then what happens is sometimes 20 years later, 25 years later, when your kids are 35 and 40, you go, now, do Bob and Gina still get the kids if something happens to us?
Okay.
That's right. So things change. Life is always changing. And once in a while, heaven forbid this happen to anybody listening, we have people that die out of order. Things don't happen the way we think. A husband or a wife dies early. We need an estate plan for that. Or a child, heaven forbid, dies early. We need an estate plan for that. Maybe we inherit money. Maybe we have monies in different locations, and maybe it's stuff that we haven't thought about. How do we put a beneficiary on everything? And how do we make sure that it's a living beneficiary designation? Meaning, when you have a trust versus just beneficiary designations, the trust will take into consideration all that, what they call the parade of horribles, all the things that could happen and go wrong, we address inside the trust in one fell swoop. And as long as we make sure the trust is the ultimate beneficiary, the trust has the ultimate power. Maybe it is when you've died and you're passing your wealth on to your kids. Maybe one of your children's going through a divorce. Maybe they're incarcerated, heaven forbid. Maybe they have been or are being sued by somebody, so the trust can help protect your kids against all those sorts of things, as well as just making sure that we keep the court system and probate out of any scenario that would come along upon your death as you pass assets to your kids.
All right, Randy. Now, you've talked about trust, but I want to go back here and talk a little bit about the backbone of an estate plan, and that would be the will. What exactly is a will, and what does it do as opposed to the trust?
Sure. So basically, a will ends up being instructions to the probate court. It's really what it gets down to.
You're making an appointment with probate if you've got a will. Is that what you're saying?
If you only have a will
Right.
and you don't put beneficiary designations on your accounts of some sort, your kids are going to probate. You're dead, but your kids are going to probate. If we have beneficiary designations like POD, pay on death at bank accounts, TOD, transfer on death on automobiles and vehicles, beneficiary deeds on property here in Missouri, those things do avoid probate. But what they don't do is there's some things that they just don't address. Like, case in point, let's say mom and dad had a farm, and we see this come up. And it says in the will that the kids get the farm, it passes right on over there to them, and they have an undivided equal interest. Well, that's great. The two kids own it on a beneficiary deed. So when you draw your last breath, you've got that set up, and maybe they're married and they've got several kids, and the one spouse says, I don't really want to sell the farm, and the other spouse on the other side says, I really need to get the cash out of there so we can retire. I mean, who wins and who buys who out, and how do we work that out? Whereas if we have a trust and something that really spells all that stuff out, it doesn't have to be figured out at the worst possible point in people's lives.
So a will is one thing, a trust is another. And you have explained this, that, having a will sometimes is like filing a lawsuit against your kids.
Right. Yeah, because, in the state of Missouri, I think average probate time is around 8 months, best you can do.
Wow.
I mean, that's a while.
What happens if someone passes away, they do not have a will or a trust?
Well, they die what's called intestate, and then, of course, you're back into the probate court, and then there's the heirs at law that the probate court will try to find your kids first, and then brothers and sisters, then mom and dad, then nieces and nephews, and there's a whole hierarchy there.
So if you've got a will and you've got a trust, which takes precedent? Do we look at the will first, then go to the trust? Should you have one versus the other, or just one, or should you always have both?
So you're going to have both. You want to have a will, because a will is going to look at all that personal property and things that don't have a proper title, so you can put it where it's tied to the trust. Now, we do what's called a bill of sale many times inside these trusts. I say we. I'm not an attorney. I don't do any of these, but attorneys do. They will have a bill of sale and it puts all the personal property and everything under the guidance and the purview of the trust through that bill of sale. But we always want a will just as a catch-all for anything that we might have forgotten. But again, what we really prefer to have is a beneficiary designation of some sort. And we like to have a trust because it will cover all those possible contingencies that we don't think of.
Randy, let's talk about who carries out your wishes. I've heard it called executor. I call it an executor.
Yeah, there you go.
What is that, and how do we pick one?
So generally, when we have a will, there is somebody that's an executor. And then when we have a trust, we have trustees, people that we pick that we trust, thus the name trustee, right?
Right.
That will carry out all of those wishes that we have spelled out in the trust. So two different titles really, and the executor is generally going to operate under the guidance of the court, where the trustee is just going to operate under the guidance of the trust.
All right. Some people put their houses in a trust. Why would someone want to do that?
Yeah, again, depending on what the situation is and how the trust is spelled out. You know, if you have a house and it's a beneficiary deed, you got 5 kids. Well, when you die, if those 5 kids are still alive and you pass the house to your kids, well, each of them owns 20% of the house. Maybe they're all married. So now we have 10 people trying to decide the disposition of the house. Not good.
No.
Whereas the trust can say, hey, upon my death, the house is to be sold and divided equally amongst my 5 kids. It's things that we can, and we can do that in a will. But again, what if somebody dies out of order? Do we want to disinherit grandkids? Maybe we don't even know those grandkids aren't even alive when we write this trust, but later they are, but the trust can provide for them.
Randy, with all the online tools out there, some people wonder if they really need an estate planning attorney. What do you think?
So I would tell you that it's kind of like doing taxes, right? Everybody could probably figure out how to do their taxes if they wanted to take the time, number one. But the second thing is, what am I missing that I don't know about? And what is it that I just don't know? Sometimes knowing that we don't know and asking for help is the very best thing we can do, right?
Right.
You know, it's kind of like riding bikes. Today, I know a lot about riding bikes. In the beginning, I knew nothing about riding bikes. People say, well, I know how to ride a bike. I get on there, I pedal, right? Well, yeah.
To a certain extent, yeah, but
to
taking it a lot further than that, according to the number of bikes in your garage. How many bikes are in your garage right now, as a matter of fact?
In the garage, I have 10. In my living room, I have 2.
How many bikes do you need?
Well, N, which is the amount you currently have, the number you currently have, plus 1.
Okay, so that's what you need. It doesn't make any difference with bicycles, anything you've got, whether you're collecting guns or cars, the number you should have is the number you've got, always plus 1. Anyway, we got off on a tangent here. Let's continue the conversation here about wills and trusts. And as you said, you can do them online, but you don't know what you don't know. And there are some things that you could be skipping. And I understand that if you do not include some things in this will properly, that you could be setting yourself up for unnecessary taxes.
That's true, especially depending on what your net worth is and things, and how the trust would handle IRAs and all that sort of thing. Man, there's a lot. And again, depending on what your situation is or what your kids or your beneficiaries' situation is when you pass away, there's many things in the trust that's there to protect them.
Randy, if someone is getting ready to start an estate plan, what should they bring to that first meeting with the estate planning attorney?
Yeah, so generally speaking, they don't have to bring anything. They can have a general conversation. However, if they want it to be productive, they should have an idea of, how much property do I own? What are my bank accounts? And maybe have those things with them. In the beginning, what Elizabeth does is she likes to sit down and figure out what people's goals and desires are, figure out what's important to them. And then from that point, there's generally going to be a second meeting. And that's when they really get down to brass tacks, where we're going to be looking at property deeds, looking at accounts, and renaming the beneficiaries to the trust potentially, and really setting up the estate plan so that it becomes almost automated. Yes, you have to have a trustee to execute, but it's almost automated And then we also want to make sure that, and she's got a lot of experience at this point, making sure that you write the trust in very concise language so that it doesn't create its own problems. Like sometimes we'll have people that will give away a farm inside a trust and just give an equal share of 500 acres or 640 acres to 4 kids. And then we have this situation that it doesn't talk about maybe how to structure a buyout or who gets what portion of land, because not all land is created equal. Right. And it really creates some problems. Well, you're going to get this 140 over here, and you're going to get that 120 over there, or whatever. And, well, I don't like that 120 over there. I want your 140. Right?
One's fertile land, the other's rocks.
Right. So there's just a lot that goes into the drafting of the language of the trust and the final disposition of how that's to go that will either set people up or keep people from being set up to fight after you're gone.
And Randy, you alluded to this a little bit when you mentioned Elizabeth. Where can we find a good estate planning attorney?
Yes, at the Floyd Law Group. Now, we office out of the same building, but we have independent people that help on the paralegal side with Elizabeth versus the financial planning side. So independent companies operate totally independent. You can do both, or you can do neither, or you can do one or the other. So it doesn't matter.
Great advice, Randy. It sounds like keeping your estate plan up to date. It isn't just about documents. It's about protecting your family.
Absolutely. I mean, I think that everybody, now I have one guy that he said, I'm not assigning a beneficiary to anything. I want to create a complete mess when I die.
Oh, my gosh.
That's exactly what he said.
Wow.
He said, I want the courts to go ahead and battle it out. I said,
why would you want to do something like that?
I don't know. But most people would like to think everything would get divided the way it's supposed to, and all their kids would be happy and remember mom and dad.
Oh, yeah.
With fond memories, and boy, they did a great job. Thanks, mom and dad.
Well, you're going through enough when a parent passes away or a loved one passes away. I don't think that you want to create a mess for people. So I think this, if you love your family, you want to do what's right, you need to have an estate plan, and that can include certainly a will and a trust. And if you don't know where to go, Floyd Financial Group can give you a hand with that. Elizabeth is an estate planning attorney. It's the Floyd Law Group, and the offices are right here in the same beautiful building. I always said that sort of looks like Tara. So if you would like to have a sit down with Randy and Jake at Floyd Financial Group, we're offering it no cost, no obligation, no judgment. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Randy, it has been a pleasure to be with you this morning. I think Jake will be back next week from vacation. So for Randy Floyd, I'm Jeff Shade. Thank you so much for listening. Be sure to join us again next week right here for another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.